Hi, I'm Joe Yasinski, Vice President of Sales at Gold Bullion International, or GBI. Today we're going to explore the question, is gold a bubble? And this is a natural question to ask. Gold has run from about $250 an ounce back in 2001 to just almost over $1,800 an ounce today. And if Americans are familiar with anything, they're familiar with the nature of bubbles. In 2001, we saw the dot-com stock bubble blow up on all of us. And then recently, in the past couple of years, we've seen the real estate bubble leave a trail of tears for people that chased recent performance. So it's natural to ask yourselves, is gold a bubble? Has it run too much? Rather than dismiss gold as a bubble outright, what I want to do today is explore some of the fundamental factors that are driving the gold price, and why we believe that after taking a look at the actual data, as opposed to just reading the headlines, it doesn't take long to come to the same conclusion that we have at GBI, that not only is gold not a bubble, it's actually one of the most underowned, underrepresented assets available in clients' portfolios today. For much of the past decade, central banks have actually been net sellers of gold. As a matter of fact, for essentially the last 20 years, central banks around the globe have been a major source of gold available for purchase. What you see in this chart is that what was once a source of supply in the gold market has now become a source of demand for physical gold. Central bank purchases are accelerating as well, as they rapidly try to replace dollar reserves with gold reserves. Central bank purchases through June of 2011 have surpassed all purchases in 2010. This year, central banks are on pace to acquire over 500 tons of gold. That alone represents 20% of all the gold mined in the world in a year. Investment demand is also skyrocketing, especially in the East. Through June of 2001, the Shanghai Gold Exchange has delivered over 200 tons of gold. China and India's imports alone represent 50% of all global mine production. When you add in demand from jewelry, individual investors worldwide looking to diversify from their currencies, as well as industrial demand, it quickly becomes apparent that gold demand cannot be satisfied by how much we take out of the ground every year. Thus, prices need to rise to a sufficient price to coax enough people to sell what they own. Compounding the issue is declining mining production. During the last few bubbles, the ultimate pop came from an abundance of supply relative to demand. When demand spiked for access to dot-com companies, there were a slew of IPOs to satisfy that demand. And as the demand for housing raged on in the late 2000s, builders were happy to build miles and miles of new developments to satisfy this newfound demand. Take a look at the attached charts to contrast these facts to the trends in gold. As you can see, in spite of gold's upward price trajectory, global mine output has actually fallen since the year 2000. Why has this happened? This has happened because gold isn't easy to find, often requiring the mining of over 30 tons of rock and earth just to mine 1 ounce of gold. Mining companies are simply not discovering new sources of recoverable gold to meet growing demand, even at these prices. The next question we're going to ask ourselves is gold over-owned? Before we look at some data, ask yourself this question. How many people did you know that played the stock market in the late 1990s? Or how many people do you know that were flipping real estate in the late 2000s? Even speaking for myself, I often felt left out when many of my friends and family were buying 2 or 3 homes at a time. If I compare how many people I knew doing this kind of thing compared to how many people buy and own physical precious metals, it's not even close. The numbers bear this out. A quick look at the following chart illustrates how little of their assets investors have in gold. Even after gold's substantial run-up in price, we can still see that it represents well less than 1% of investable assets. And comparing that number to our recent past, we can see that investors are still woefully underexposed to gold. With this number viewed with the backdrop of increasing demand and declining production, the gold as a bubble thesis becomes less and less believable. Is the price really that high? The short answer is no, not really. In real terms, meaning in dollars adjusted for inflation, gold is still almost 40% less than its all-time high. Gold even looks cheaper when you look at it in comparison to how much money the United States has and continues to print, as you can see from this chart. In order to avoid dramatic fiscal cuts that would arise from the U.S. housing crisis and to continue to fund our deficit spending, the U.S. government has been forced to lower interest rates to zero and print money in unprecedented amounts. This bullish trend for gold, like many others, is accelerating. For example, just 10 short years ago, the United States was running a deficit of approximately $120 billion a year. Today, just 10 short years later, we run a new $120 billion deficit every 3 weeks. This is before a mountain of baby boomers begin to retire and our entitlement obligations skyrocket. The response from our government has been clear. They're going to print more money to fund all of these obligations. Now, that's all fine and good if you're the federal government and you can print dollars to pay your bills. But what about the person who is saving his excess earnings in dollars? Should he or she simply sit and watch the value of their savings unit diluted away amongst a massive wall of freshly printed money? How can you as an investor protect yourself and your life savings from this unpleasant but easily forecasted reality? More and more investors, but still quite few, are moving away from our easily printed and manipulated dollar, and instead of saving their excess labor in paper and a paper asset with a 41-year history, they're opting for an indestructible, apolitical, and unprintable currency with a 6,000-year history of maintaining and growing your purchasing power. Gold alone stands as an asset that cannot default, it cannot be downgraded, and it cannot have its value diluted away. Gold stands as a true portfolio diversifier, one that takes your excess hard work and diversifies it away from our electronic and paper monetary reality into a physical asset, an asset that truly diversifies you away from the risks of too much debt, too much money printing, and too much government intervention into the value of our currency. Here at GBI, we believe that all of these factors will lead you to the conclusion that not only is gold not in a bubble, it's actually quite undervalued. When you look at all the fundamental factors that have been driving gold's price higher, these factors are actually accelerating, they're not diminishing. When you look at the money printing coming out of central banks, when you look at increased demand coming from institutions and from retail investors, when you look at decreasing mine production, and you add in the fact that gold is still roughly about 40% below its inflation-adjusted high, it becomes very, very difficult to come to the conclusion that gold is in a bubble. The opportunities to invest in gold are many, each with their own risks and benefits. My hope, and the hope of everybody at GBI, is that you will allow us to help you, guide you through this process, and if you have any questions or concerns, we're here for you all the time. Thanks very much, and I appreciate your help, and thanks for watching. Take care.